Institutional investors. These are the folks who chase alpha harder than Wall Street interns. Chase approval from their managing director, who doesn't even know their name. Lately, these interns and the trillion-dollar funds they serve have been obsessing over one asset class. Not stocks, not crypto, not real estate, not even AI. It's an industry that's grown tenfold since 2007, quietly minted a new wave of billionaires, and is so boring sounding it makes municipal bonds look like a party. That industry? Private credit. The most mundane sounding corner of finance has ballooned into a $2.5 trillion juggernaut, bigger than Canada's GDP, for context. But honestly, GDP comparisons rarely win dinner table arguments. Here's the kicker. Over the last 20 years, private credit has delivered returns almost identical to the stock market, but with far less volatility. Stock-like gains without the stock-like emotional roller coaster. So if it's so great, why has nobody outside Wall Street heard of it? That mystery sent me on a 2-month deep dive into this secretive industry quietly taking over finance. You might have heard about private credit from that finance bro. You know the type. Patagonia vest, Red Bull in hand, nicotine pouch practically fused to their cheek. But in case you haven't, here's the gist. Imagine a company needs a loan. 30 years ago, they'd walk into a bank, dap up a banker named Tucker, and boom, loan approved. Tucker didn't care about your credit score, income, or the fact your last business was a failed vape shop. Loans were handed out faster than rashes on spring break. And surprise, this generosity nearly blew up the global economy. Post-2008, banks became strict parents. More rules, more capital requirements, and way less fun. Nowadays, when you walk into a bank, you beg for a loan, fill out 50 forms, offer your firstborn as collateral, and maybe, just maybe, they'll give you money. And that's where private credit steps in. Think of it like the sketchy uncle who says, "Forget your report card, I'll give you cash now." But the interest rate's spicy. Companies borrow from non-bank lenders like Blackstone, Apollo, or Ares. They cut direct loans, charge higher rates, and deliver strong returns. It's basically Venmo, except your buddy isn't sending $20 for pizza. He's wiring $200 million to a mid-market oil refinery to keep it afloat. Why does private credit work so well? Because finance, like your ex, follows one rule. If there's a hole, someone will fill it. In the early 2000s, private credit was tiny, around $140 billion globally. Basically the weird sibling of private equity. Then 2008 hit. Banks have been handing out loans like candy. Ninja loans, no income, no job, no assets, and CDOs. Yes, the ticking time bombs called collateralized debt obligations, plus the infamous CDO squared. And shocker, it all came crashing down. Banks blew up the economy. Regulators stepped in, told banks to act like adults. More capital, less leverage, stricter lending. Result? Middle market companies, too big for community banks, too small for Wall Street bonds, were suddenly loan orphans. Private credit swooped in. Forget the collateral. Sign here, pay 10% interest, add some fees, welcome aboard. Companies lined up faster than shoppers at a Lululemon sale. Assets under management went from $300 billion in 2010 to over $1 trillion by 2020. A 10x explosion, transforming private credit into Wall Street's favorite money machine. Over 20 years, private credit returned 9.6% annually. Stocks returned 10.2%. So why are investors obsessed? And the answer comes down to two words. Two words that make business. Whisper, "This is it, boys." Two words that make that girl a couple desks over from you say, "Maybe he's not such a nerd." Two words that make investors salivate just at the thought. And the two words are stable returns. Private credit? Smooth, boring, inconsistent. After a decade of near-zero bond yields, private credit became the Goldilocks asset. Too risky for banks, too safe for hedge funds, just right for institutions managing $30 trillion. Equity-like returns, bond-like volatility. But it's not all rainbows. Risks exist. Liquidity, mark-to-market valuations, defaults, leverage. No exchange, No public pricing. Valuations are guesses until someone stops paying. Still, Wall Street loves it. Investors will overlook cracks as long as the 8 to 10% annual interest payments keep coming. The industry's big bet? Borrowers keep paying, and for the last decade, they have. Maybe private credit is Wall Street's hottest new industry, or maybe it's the latest bubble in a fancy suit. Nobody knows, and the time will tell.